Okay, welcome everybody. It's what is it? May 6th, 2022. Maybe a week to forget. Hey Ben?
Hey, it's been quite the week. I find anytime you take holidays, you come
Yeah,
back to the week that we had,
yeah. Let's just be
which
blunt. Let's just be blunt. Shitstorm. Shitstorm.
was a bit of a shitstorm.
Oh, I know. Well, the weather's nice.
That's a positive. I
If
brought
nothing
that for
else,
you. You're welcome.
I broke out the shark skin suit, ready to have a good show today.
I see that Miami Vice. I like it.
I know. I know. Okay, how do you want to start? I know you got we have a ton to cover today, so why don't you just tell us what's on top of your mind?
Yeah, so I think a lot of things are on top of my mind. Continue to have great, productive conversations with clients. But one of the things that we continue to talk about is, one of those unique challenges when we go through a transition, which, if we came into the start of this year, I said kind of Q2, I expected we probably see a slowdown, but right out of the gate, we got slammed out of the gate. And so I had the portfolio position for one thing. January sold off. February, we got a bit of a rally trying to reposition. And the constant goal and battle is trying to position for what's ahead of us. And when you're trying to position for what's ahead of us, sometimes you're early on some things. And so in the present tense, we've been early on having exposure to bonds and duration. The constant question I continue to have back to clients, as you do as well, Scott, is what would the alternative be? Like if we were sitting in stocks, well, stocks are down more than bonds. Would be sitting in cash. Well, would you want to be sitting in cash, or would you want to be sitting in something else? And so it's the constant battle of trying to make sure we're positioned for what's coming in front of us, but also at the same time trying to be conscious of what's like happening right in the current position. So, I'd say that's been the I guess point and counterpoint I've had most conversations around over the last couple of weeks.
Right, and part of the tricky part is also there's never really been another time like this, right, where everything's gone down at the same time.
Yeah, so over the last 100 years, we've had two events really. One, I think we had three if you count 2018, but the bond market really wasn't down much that year. So, like in our investing lifetime, in pretty much all of our investing lifetimes, we haven't had this event where stocks and bonds go down together. So, the question I continue to look at or at least question myself around, what's the likely outcome from here? And so, we're positioned how we're positioned. And then I say, what's the likely outcome? Do we hammer our foot on the gas of equity risk? Or do we hammer our foot on the gas of bonds, or do we mostly be patient? And so generally, I've been staying in that patient bucket. Um, but because I do expect that, based on what Powell said this week on Wednesday, anyways, when he raised interest rates 50 basis points, it sounds like he's got his foot on the gas in regards to inflation. And so if you listen to his conversation, he said, we're going to fight inflation. And I hope we have a softish landing in the economy. And so he kind of said to the world that we don't care what's going to happen to the economy and markets, and we'll do what we can to fight inflation. So I think that's what we've seen out of the market in the last 2 days. Wednesday was a bit of a kind of a relief short covering rally, but the last 2 days been kind of further downside. So yeah, you're right. It's a rare event where this has happened. But then I say to myself, which way do we lean? And I still lean towards a recession is, coming into the year, I would have said a recession is probably, a 50% chance of happening. Now where we are based on the economy and based on what the central banks are doing, I'd put that closer to a 90% chance that we have it this year. So with that as my base case now, bonds in that backdrop do extremely well. And so I still think that bond positioning is going to offer the best risk reward by the time we get to the end of the calendar year of 2022.
Right. And the thing is that's usually the hardest bucket to sit in, is the patience bucket, right? Like the natural reflex for everybody is we got to do
Yeah,
something.
yeah,
We got to do
yeah,
something, when a lot of the time in those situations when the knee-jerk reaction is we got to do something, is really to do nothing,
yeah,
right?
yeah, exactly.
Right? Because then you just end up making the wrong decisions, right? For sure.
Exactly. Yeah, listen, I
Human nature.
actually had this book out here, and the
Yeah.
quote that I'd pulled by
Oh,
chance says, "Have patience. All things are difficult before they become easy." And so, I mean, to your point, like a lot of these these conversations I've had in the last couple of weeks is, well, you knew interest rates are going up. Why didn't you do this? And so, one of the things I look at is, we are where we are. I am early in some instances, but I've been lagging into that position over the past 5 months. Now is the time for a little bit of patience,
yeah,
particularly with those positions.
for sure. For
Yeah.
sure.
Mm.
And I think you can tell by our tone, we've been getting a lot of these questions the last week or two.
Yeah,
So,
absolutely.
um, okay, so that being said, then, did you want to talk about what you've been doing in the portfolios or not doing? Is this we kind of segue into the not doing, I guess?
Well, we generally do too, but as you know, some time away as well, and some reflection time. I think about it, and we've been talking about Web3 now. I guess more front and center for 6-9 months, but more likely the whole time we've been doing this the last 2 years. And if I were to tell you 6 months ago that you could buy Facebook at 200, or you could buy Shopify at 300, or you could buy Coinbase at 100, you would have said I was crazy. That's impossible. It's never going to go there. And so now we start to look at some of these levels here, and you look at Facebook, whether you love them or hate them, currently trading at 15 times earnings for a growth company. And you look at Coinbase, which is the biggest exchange in the crypto space. So listen, if you think Web3 doesn't exist, it's never going to matter, then this is a crazy conversation. But when I sit here and look at it, I say, Coinbase trading at $100. I don't think crypto is going away. So maybe I want to have some exposure there. So that's something I did today, which is reduce a little bit of exposure into Japanese yen. The yen has essentially been thrown to the wolves because they've decided to peg that their interest rate at the 10-year at 0.25. As a result of that, that beats the shit out of their currency. And so if you actually track overlay Coinbase over the yen for the last 6 months, they've actually tracked pretty closely. So as we look, I made a small shift, took some money out of yen, and bought some Coinbase today.
Beauty.
Yep.
What anything else before we get into the chart segment?
Yeah, so as I at the end of every week too, I go through and look at the different markets, how they did, what they did, and I still think and look at bonds as the place from a best risk reward that you can add to if you're not fully positioned for that. So as I have some new clients coming in, new money coming in, we're still adding to those positions because I haven't changed my view there. As I follow Hedgeye and their research and also their signals, Keith McCullough, who's their CEO, he talks about when he's going to increase his position sizes and things like that. And so, he's taken bond allocation up to kind of medium to max positioning this week. And so, that's interesting as well, and kind of lets me think a little bit about how and where he's doing that. So with new money, still adding to cash and bonds, I still think that's the place and still the best risk reward because there's still lots of uncertainty ahead.
Right.
Mm-hmm.
Okay. Well, what do you got for us?
All right.
And we should mention while you're getting those up, we have a special mid-year review next Friday.
Yep.
It's going to kind of replace this, and that's what you're going to go over is kind of how we got to where we're at and what we anticipate for the next 6 months. Is that right?
Yeah, absolutely. Yeah. Yeah.
Okay. Yeah.
Yeah.
So we'll
So
send an email out on that sooner than later, just letting everybody know it's happens or it's happening. Yeah, but that's next Friday, same time. So
yep. Yep.
yep.
Yeah. So I'll send that out this weekend for sure.
Yep.
But yeah, that's a great point. So as we've talked about lots of these kind of key points over the last little while, it's been, lots of conversations around labor. The central banks talk about it all the time, the employment number. We talk about housing, we talk about GDP and so on and so forth. But what I thought was interesting from at least from the call this week is Powell said the labor market is strong. And, if you, one of the dailies I put out was talking about small business, new hires is kind of the third worst number in history, came out last week, earlier this week. And then if we looked at the labor participation rate, we actually saw that turn down as well. And so this is a snapshot of the labor participation rate, at least since the 80s. It's been certainly in a downward trending cycle since, but the thing that Powell and cronies were talking about was kind of participation rate was increasing. We've actually seen a rollover now, and I think that's important because if employment starts falling, he's going to have a lot more of a difficult sell around trying to kind of keep with his foot on the gas on rates.
It's interesting.
Mm-hmm. The other, I'd say, general piece that I continue to talk about, which we continue to talk about, is real estate. Certainly the data in the US is really active and kind of real time, so we get a real good handle for what's happening there. The Canadian information still is important too, and I think almost exactly aligned with this. So this is US residential housing under construction. And so why is this important? Well, it's the highest since the 70s. And I'd say the believers that think that real estate won't be touched with higher interest rates, that continue to say, well, it's a tight labor market, or sorry, it's a tight housing market. Well, this clearly shows you that, yes, okay, it is right now in this specific moment right now, but in the second half of this year, that the inventory number is going to change dramatically. And so on the back of higher inventory and higher interest rates, that makes it a really tough environment for the US consumer.
Yeah, definitely. Yeah, I mean, there's definitely I think that's what people think, right? I talk to a lot of real estate agents still because that's where the industry I came from before here. But like, oh, it really hasn't done anything. Well, I mean, there's a lag in there for sure, right? That they don't realize. And yeah, I definitely agree with you. I think inventory is definitely going to rise.
Yeah.
I don't know in Ottawa if we'll see the same kind of, and maybe you'll disagree with this, but um, I don't know if we'll see the same kind of dip as
Mhm.
maybe some other places. But yeah, definitely a dip coming.
Yeah, I think it depends a lot on what happens to rates. And so, if we see interest rates start to fall or go sideways here, like bond rates, as fixed rates are priced off of bond rates. If we start to see them go sideways to down, I think, yeah, we probably only get a mild correction. But if you start to see kind of rates at 3 to 5% kind of across the board for borrowing, that's increased people's costs dramatically. I don't think Ottawa's immune. I think that that we see a decent correction with rates higher.
Yeah. I don't think a lot of people say, oh, it's a government town, it's stable because of that. I think a lot of it has more to do with it's in a growth stage, right? Like
Mhm.
we're anticipated to reach 2 million people. I can't remember what the year is,
Mhm.
but soon. I mean, we're one of the fastest growing cities in Canada, if not the fastest. So
Mhm.
I think that has a lot to do with it as well. But I agree, definitely the interest rates will have definitely slow it anyway, which
Mhm.
I think it needs. So
Yeah. 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 Well, I think that'll be one to continue to watch, and maybe a little bit less so in Canada, but in particularly in the US, the consumer uses their house for ATM. So, lots of refis and things like that, that'll slow the consumption. So it, I think, plays a major part in how things play out here.
Yep.
So this was a sense of what the week was like, just from a distribution curve of how the S&P 500 has traded in these kind of ranges since the 1970s. This is kind of normal distribution somewhere around the middle here. This is where most of the trading days occur, and that kind of minus 0.2 to plus 0.4. That's really where the market tends to trade. But this is what we had on Wednesday. We had a 3% move in markets, S&P, for example, on the day of the Fed. And so then on Thursday, which was yesterday, we saw all of that given back. But just to tell you how wide those swings are, I thought this was important for people to try to kind of understand the environment we're in. And so swings are wild. I continue to get asked about, why the swings are so wild. And you look across every asset class, stocks, bonds, gold, energy, crypto, you see volatility in all of those asset categories at or close to the top end of their ranges. And we haven't lived in this kind of environment since 2008, where we've had that extended period of volatility, which we're 5 months or so into this period. So we're getting these huge swings that are affecting day-to-day values. But all of this is driven by kind of the transition the economy is going in right now.
Good one.
Yep. Last one. So this is a snapshot of ARKW. This is one of Cathie Wood's ETFs. And so, continue to have conversations around what's happening in the short term versus what's happening in the long term. And one of those unique challenges is trying to position and benefit for where you think things are going over kind of the medium term, but also make smart decisions where you'll make money every year as well. But I look at Grayscale, for example. We did do a chart on this maybe 6 weeks ago, where Grayscale is one of the first kind of ETFs that came to be in the US. The SEC hasn't approved it, so it only trades OTC, which is kind of an alternative market in the US. So as a result of the SEC not approving this thing, the trust is trading at a 25 to 26% discount to NAV. So really what that means is, if you're looking at the value of a business, it's trading at a massive discount to that value. And so what is likely to happen at some point, the SEC is going to approve Grayscale's request to become an ETF, so convert from a trust to an ETF. And when that happens, that value closes immediately. You get a 25% pickup right back to NAV, because ETFs have to trade at NAV. And so, this is a snapshot of it. Wanted to just mention Grayscale, but I also wanted to say, if you picture yourself in your chair today and think about what the world's going to look like in 2, 3, 4, 5, 6 years, and you think about some of these businesses that are here on the list, for example, and you say, what's the likelihood that these are worth more in 5 years than they are today? And in all cases, I'd put the probability at extremely high, that these businesses are worth more in 5 years. So as I pick away, and I mentioned Coinbase today, look at some of these businesses. Part of it is buy them. Yeah, we're going to likely continue to see some volatility, but knowing that I'm buying this 60, 70, 80% below their highs, you're getting a little bit more confidence and comfort. Do I think they can drop another 60, 80% from here? Well, potentially some of them might, but I'd say it's pretty highly unlikely for these businesses. So I think it's just important to take a look at, what are we doing today, but also what can I do right now that puts us into a position to benefit long term.
Gotcha. Yeah, you think Tesla's going to be worth more in whatever it is, 10 years?
That's the only one that makes me uncomfortable.
Yeah.
You know, I'm not a super fan of Tesla. I don't like Musk and whatever he's doing with Twitter. You know, there's lots of pros and cons on both sides. That of this list here, that's the only one I would edit out if I could. But they seem like they've been the leader in the technology and that space. But you know, I do think that a lot of these businesses can do well over the medium term. You know, when you think about what Amazon was like, you know, Amazon's the biggest business in the world today. In 2000, the stock went down 90%. So even if you have a great idea and a great business, it doesn't always work right away. So, you know, Tesla has probably the most risk in my view out of these 10 companies. Yeah, we'll see over time how it develops.
Gotcha. Okay, good. Good charts, Ben. Good charts. Well
Yep.
done.
Thanks.
All right. Okay. Well, I just noticed something.
What's that?
My I don't have my computer plugged in and the battery's about to die. So which will be a problem because I'm
Recording
managing
it.
this.
Yep.
So why don't you bring us into what we're looking at the next week, and I will run and grab my cord there. I'll just close my camera here.
Okay, sounds good. All right, well, thanks. Yeah, so as this week was a big week, what I've been mentioning about for a while is that this is when the central bank would talk about what they were doing with rates. And so I definitely listened to Powell's press conference and read a lot of the notes afterwards. But as I think about what he's doing and what he's saying so far, it's quite a significant disconnect from what's starting to happen in the market. And so they tend to spend a lot of time on kind of rolling numbers and quarterly numbers. But if we look at the shorter term data that's coming out kind of in real time, you know, you're looking at the economy contract, and you know, we're looking at those recession numbers coming up quite a bit more quickly than people would like. So the big thing that I'm paying attention to is what the central banks of the world are saying and when they're going to make a decision to adapt their policies. And so the inflation number will be important to continue to keep an eye on, and just what they say, because the central banks are talking all the time. But I do think we have that period of time here where we're going to kind of bounce around. Well, there's this battle between fighting inflation versus continuing to keep the economy and jobs numbers stable. So, you know, lots to do, lots to pay attention to. I plan to spend about an hour next week, if you do want to join me, to go through it a bit more details, to look at the data, what it looks like, and what I think that's coming ahead of us here. So lots to cover and go through, and we'll spend more time going through that next week. Yeah, I think that's what I'm spending most of my time on, what the central banks are doing and what the inflation numbers are saying.
Great.
Yep.
Amazing. Do we have any questions? No questions today. So we must have covered everything. That's it.
Yeah.
All right. Anything else on the before we let everybody go?
No, I don't think so. They'll if there is any questions anyone wants to talk one-on-one, we can go through. But spending a lot of time thinking about what and how to plan for the future. And I think we got everybody through tax season here. If there's any tax stuff that's been dragging along, certainly let us know, and we'll come back to you. But we think we got all of that cleaned up for everyone, and we're moving on to the month of May.
For sure. Awesome. Well, thanks everybody for joining, and we will see you next week for our special mid-year review.
Sounds good. Thanks. Bye.
Bye now.